Now I'll see SA 550, that is related parties with regards to related parties. And now we'll see the objectives of the auditor, irrespective of whether AFRF, that is applicable financial reporting framework, establishes related party requirements. That is, AFRF talks about related party requirements or not. Auditor has to obtain understanding with regards to related party relationships and transaction sufficient to able to recognize fraud risk factors, like what we have learned: fraud risk factors, incentives, opportunities, pressures, or individual rationale to commit fraud, if any, arising from related party relationships or transactions that are relevant to the identification and assessment of risk of material misstatement due to fraud. Okay, we have to obtain understanding of relationships and transaction with related parties for the fraud, to recognize fraud risk factors, and to conclude whether the financial statements are affected by those relationships. Why we have to check whether the financial statements were affected or not as an auditor, why we went to the entity to form an opinion on the financial statements and internal controls thereof. So whether that financial statements were true and fair and were not misleading. And there were definitions with regards to arm's length transaction and the related party transaction. You may refer that, and we'll discuss this later. And with regards to the inherent limitations, management may be unaware of the existence of all related party relationships and transactions, and related party relationships may present at a greater opportunity for collusion and concealment or manipulation by management. These were the inherent limitations under this standard, that management is first of all not aware with the related parties and their transactions, and second thing is that those relationships provide a greater opportunity, again what, fraud risk factor, thus providing an opportunity for collusion, concealment, and manipulation by management. And auditor shall inquire what he has to do. First of all, he has to identify the entities related parties, including any changes from the prior period. Okay, first thing, related parties and the nature of relationships, whether they have control or whether through the ownership or through the like patents or etc. With regards to the assets and all, you have to find the nature, whether the entity entered into the transaction. These were with regards to the parties relationships. This is now comes to the transactions, whether they have entered or not. If entered, whether those entered identify, account for, and disclose relationships and transaction in accordance with AFRF, and those transactions were authorized and approved significant transactions that are outside normal course of business. 2 points with regards to relationship and two with regards to the transactions. That is first thing, identifying the related parties with regard any changes to the prior period. And second thing, the nature of relationship. And third, that first with regards to the transaction is whether they have entered or not. Second thing, they have authorized or approved the transaction that are not outside the normal course of business, and the AFRF, as per AFRF, they have disclosed or not. And the thing is, auditor identifies significant transactions outside the entity's normal course. What he has to do, the nature of these transactions and where related parties could be involved, he has to identify that. And auditor shall inspect. What he has to inspect, he has to inspect document, what documents with regards to the transactions, all the bank legal and third party confirmations, and minutes of meetings of whom, shareholders. That is what they're talking about with regards to parties who have control, significant control, like shareholders who are promoters etc., to meetings of TCWG and such other records and documents, all the third party confirmations and minutes, and such other documents. And the auditor should remain alert and maintain professional skepticism throughout the audit with regards to the existence of any related party relationships and transactions that were identified by the management but were not previously identified or disclosed to the auditor. And if the auditor identifies significant transactions outside the entity's normal course of business, thus not only with regards to the related parties, but to any other person that is outside the entity's normal course of business, he have to inspect what he has to inspect the contracts and arrangements. This is with regards to the related parties. He has to identify the nature of transaction and what related parties are involved in. This is normal parties which were we have not finalized or identified them as the related parties, but entities normal course of business, that's outside normal course of business. What you have to do, you have to inspect the contracts and whether the transaction suggests that they may have entered into for fraudulent financial reporting, like for window dressing the financial statements and conceal the misappropriation of assets. And he has to check whether they have been doing that and the terms of those transactions, and the transaction whether they have been appropriately accounted and properly adequately disclosed or not, and obtain audit evidence that transactions have appropriately authorized and approved. Whenever there comes a transaction, there comes the approvals and authorizations. What they have to do, what first thing, documents, contract documents and the terms they have, and whether they have an intention to what fraudulent financial reporting and conceal the misappropriation of assets. We have to check that. And we have also to check the objectives of the order. What's the objective of the order, whether the transactions have been appropriately accounted or not, and whenever their transaction there comes appropriately authorized and approved. Okay. And identification of previously unidentified or undisclosed related parties or significant related party transactions which have identified by the auditor, which was not previously identified by the management, or which have not been disclosed by the management. They have promptly communicate the relevant information to the other members of the engagement team, the partners. Since it's a significant matter, they have to discuss to the engagement team and request management to identify all transactions with this newly identified related party. First, we have to communicate with our engagement team members, and then we have to make a request the management to identify all transaction with this new related party and inquire why entities control failed to identify that relationship and that related party transactions. We have to question the internal controls also and perform appropriate substantive audit procedures and reconsider the risk. After we have found new information, what we have to do, we have to change the overall audit strategy and change the audit plan, etc., right? Detailed audit plan, and perform such additional audit procedures other than the planned audit procedures. And if any non-disclosure by the management appears intentional, if the intention, if it is done intentionally, that are unidentification and not identification and not disclosing was made by the management intentionally, then you have to evaluate such implications on the audit. What you have to write with regards to this is management putting scope that it would cast a doubt on the reliability of the management, all the audit evidence that was obtained and the written representation that were given by management. You have to reevaluate the objectivity and the integrity of the management, their ethics and all. That's what you have to do. Okay, what we have to do when we find a new related party, first thing, we have to communicate with our member and request management that these transaction identify all transaction with this party and why this internal control failed to do so, and provide and do modifications with regards to the overall audit strategy, audit plan, and do additional audit procedures and perform substantive audit procedures. And if it is intentional, you have to also evaluate the implications of the audit, whether you have to withdraw or just modify or give disclaimer of opinion, etc. And with regards to the fraud risk factors that are associated with related parties with dominant influence, like one entity or one particular person is having a dominant influence, what all the things that he could do, what he could do, the related party has voted, refused to accept. Voted is something that is to oppose or refuse to accept the significant business decisions taken by management or TCWG. That related party is having a dominant influence, like he has been having shares for 15 to 20% and all. He could, what he could do, he could refuse to accept the business decision taken by the management or the TCWG who were actively involved in the business. And the significant transactions are referred to the related party for final approval. Who has to give the final approval? The audit committee has to give. But due to his dominant influence, what he could do, he could give the final approval. That's again a risk. There's a little or no debate among management or TCWG regarding the business proposals initiated by the related party. You see, first thing, the related party who is having dominant influence rejected the business decision taken by management and DCWG. And with regards to the decisions taken by the related party, there is no or little debate among the management and TCWG. That is, they have been accustomed to act. They have been accustomed to act, the management and TCWG. Heard it somewhere, right? In law. Transactions involving the related parties are rarely independent and reviewed and approved. These transactions were rarely independent and they were rarely reviewed and approved. And that's it. And now we'll discuss few points with regards to the verification, how to verify the existence of related parties. How do you have to verify those related parties? First, through entities' IT returns, information supplied by the entity to regulatory authorities like registrar or RBI, SEBI, etc., and shareholder register to identify principal shareholders, and statement of conflict from the interest of management and TCWG, and contracts or arrangements, significant contracts, life insurance policy, significant contracts that were renegotiated, and internal auditors report and record of entities investment and pension plans. You need not remember all these things. What all the things how to remember is all the regulatory requirements, IT returns, that information supplied to the regulatory authorities, and then with regards to the shareholding and some significant contracts, etc. Write these 4 to 5 points. It was more than enough for that. And the transactions outside entities' normal course of business may include what all those transactions that we have to do. You see, where we have seen this, we have seen it here, right? Yes, here there were few transactions that were outside from the entity's normal course of business through another party. What we have to do with that? How? What are those transactions for? The like corporate restructurings or offshore transactions with offshore entities having weak corporate laws, and leasing of premises or rendering management services for no consideration, and sale transactions with huge discounts, and transactions with circular arrangements. Circular arrangements was something that they were a series of transactions that who paid only receives the inflow of the cash. That is, who had paid. That is like taking money out from one pocket and putting it into the another pocket. That's it. And all the transactions in between were just drama. And the transactions under the contracts were that have terms have changed before the expiry, and that's it. These were all the transactions. And we have completed essay 550 also.